Gold's been rising steadily. Some say it's near its peak. Others say it's just getting started. So, should you still buy gold in 2025, or is it already too late? In this video, we'll break down what it really means to hold gold in your portfolio, how to invest in it through ETFs, and why 2025 might be a misunderstood but pivotal moment for long-term investors. Welcome to Investment Club No Fees, where we take the fear out of finance, one decision at a time. Let's start with what gold really is. Gold isn't a growth engine. It doesn't pay dividends, it just sits there. But that's the point. It's the ballast that steadies the ship. Historically, many model portfolios allocate 5 to 10% to gold or precious metals. For example, the Permanent Portfolio by Harry Brown puts 25% in gold. Ray Dalio's all-weather portfolio includes around 7.5% in commodities, including gold. Why? Because gold behaves differently from stocks due to its unique properties. It isn't tied to corporate earnings or consumer demand, and it doesn't rely on growth expectations. Gold is seen as a store of value, especially in times of uncertainty. When equities fall hard, investors often flee to safety. Gold, which isn't affected by declining earnings or bankruptcies, becomes a preferred shelter. In 2008, while the S&P 500 dropped nearly 50%, gold rose over 25%. During the COVID panic in early 2020, gold gained as investors fled risk assets and central banks injected liquidity into the economy. That counter-cyclical behavior is what gives gold its hedge-like quality. Over the past 50 years, gold has returned around 7 to 8% annually on average, less than equities, but more than inflation. What makes gold unique isn't just its return, it's when those returns show up, often when nothing else is working. That means gold didn't just protect your portfolio value, it bought you time, it bought you confidence. And that's the difference. Gold doesn't exist to make you rich, it exists to help you stay invested. So what about now? 2025. Gold's had a strong run, it's hovering near highs. But here's what most people miss. Gold doesn't usually peak because of technicals. It peaks when fear does. Today, U.S. interest rates are expected to decline as inflation softens, but new tensions are building. The Trump administration has reinstated and expanded tariffs on a wide range of imports, affecting not just China, but also longtime U.S. trade partners. These actions have drawn legal challenges and stirred up fresh uncertainty across supply chains. Although early data shows only limited short-term inflation impact, economists warn that continued trade friction could drive costs higher over time. And if businesses begin passing those costs on to consumers, the Federal Reserve may find itself cornered, balancing the pressure to lower rates for growth against the risk of reigniting inflation. This backdrop of unpredictability makes gold especially compelling. It's not just a hedge against inflation, it's a hedge against policy whiplash. As the Federal Reserve holds steady on rates for now, and with markets increasingly unsure how far the pendulum will swing, gold becomes a stabilizer for portfolios seeking clarity in the noise. So where might gold go from here? If the economy slows and the Fed cuts rates sharply, gold could continue climbing, possibly testing new highs, especially if inflation expectations rebound or the dollar weakens. On the other hand, if trade tensions ease, inflation remains stable, and equities begin a new growth cycle, gold may stagnate or pull back. But long-term, gold's utility doesn't depend on one perfect setup. It earns its place by being there when things break, not because we know what will break. The question isn't just, is gold too expensive? It's, what role is gold playing in your life right now? Gold matters most in two moments: before the panic and after it. During crashes, equities plummet and people panic sell, but portfolios with a gold allocation are often more resilient. That cushion can be the difference between staying invested and bailing out. Take a simple example. Imagine two portfolios. One is 100% stocks, the other is 90% stocks and 10% gold. In a market crash where stocks drop 40%, but gold rises 10%, The all-stock portfolio falls by 40%. The mixed portfolio would fall by 90% of 40% minus 10% of negative 10%, resulting in an overall drop of approximately 35%. That smaller drop doesn't just preserve capital, it preserves confidence. After the panic, that's when rebalancing comes into play. You sell a portion of gold and buy equities at a discount. That's disciplined investing, not emotional reacting. Gold helps create that opportunity. Gold's job isn't to dominate your portfolio, it's to keep you from self-sabotaging it. Let's get practical. You don't need a vault or physical coins. For most U.S. investors, gold ETFs are the simplest entry point. Two of the most popular options are SPDR Gold Shares and iShares Gold Trust, known by their tickers GLD and IAU, respectively. GLD is one of the most widely traded gold ETFs in the U.S. market. It offers exceptional liquidity, making it an attractive choice for institutional investors and active traders who need to move in and out of positions easily. However, this comes at a slightly higher cost. The fund carries an expense ratio of about 0.4% and is structured as a grantor trust, which means it is taxed as a collectible. For U.S. investors, that could result in long-term capital gains being taxed at a rate of up to 28%. In addition, GLD typically trades at a share price over $180, which might be a barrier for retail investors looking to build small positions gradually. IAU, on the other hand, tends to be the preferred option for long-term investors who prioritize cost efficiency. It has a lower expense ratio, around 0.25%, which can make a real difference over time for those following a buy-and-hold strategy. IAU is also backed by physical gold, just like GLD, but trades at a lower share price, generally in the $30 to $40 range. This makes it much more accessible for dollar-cost averaging or building positions over time. While it has slightly less liquidity than GLD, the lower cost and easier entry point often outweigh that difference for most individual investors. If you want broader exposure, there are also multi-asset ETFs with gold allocations. Alternatively, some investors explore gold mining ETFs like GDX or GDXJ, but keep in mind, those are equity-based funds. They tend to be more volatile and correlate more closely with stock market movements. If you're looking for price stability and direct exposure to the metal, stick with GLD or IAU. You can start with 5 to 10% of your total portfolio. Automate it through dollar-cost averaging. Let it grow quietly in the background. And if you're investing through an IRA or Roth IRA, you may be able to defer or even avoid the higher collectible tax rate. Just make sure your broker supports commodity ETFs in tax-advantaged accounts. Avoid overthinking the timing. With gold, consistency beats prediction. So, should you own gold? If you're chasing high returns, maybe not. But if you value peace of mind, if you want to stay invested when others are losing their nerve, gold can help. It's not designed to outperform equities over the long haul, but it's designed to give you the confidence to hold on to equities when they're under pressure. It won't do the heavy lifting, but it lets your stocks keep doing theirs. Think of it as emotional insurance. It doesn't pay off every year, but when it does, it matters. One common misconception is that gold is a perfect inflation hedge. The truth? It's a hedge against uncertainty, not just inflation. Sometimes it lags behind CPI, but it tends to surge when trust in currencies, governments, or markets starts to erode. That combination, especially during uncertain times, can be more powerful than people realize. If today's video made you think more seriously about downside protection, you'll want to check out Market Crash: How You Should Protect Your Portfolio. It's the next step in building resilience, not just with gold, but with your entire strategy. Thanks for watching.